Over the last decade, a massive lending machine has been built, almost entirely in the shadows, completely outside the regular banking system. It's called private credit. And for a while, it was the hottest thing on Wall Street. But now, after this period of just explosive growth, we're starting to see some serious cracks forming. And that's sparking fears of a real crisis in this $2 trillion market. So let's get into it and see what's really going on. When the CEO of the biggest bank in America says something like this about a financial problem, you listen. His comment really captures this growing fear that's spreading right now. Are the problems we're seeing just a few isolated incidents, or are they a sign of something much deeper, a hidden rot in the system? And yeah, there are clear symptoms of a panic brewing. Investors are scrambling to pull their money out, which is forcing major funds to literally block withdrawals. The stock prices of some of the big firms that run these funds, they've tanked. And people are starting to whisper that dreaded comparison. Is this starting to feel a little too much like the lead up to the 2008 financial crisis? So what is actually happening here? Is this just the market getting spooked by a few bad headlines, or are we looking at the beginning of something much, much bigger? That's really the core question we're going to try and unpack. But before we can even begin to understand the panic, we have to understand where it's coming from. So let's take a step back and explore the world of these so-called shadow banks to get a handle on what private credit actually is. Okay, so the simplest way to think about private credit is like this. It's basically the private equity of lending. You have these big investment firms that raise a ton of money from investors. But instead of using that money to buy companies, they lend it directly to them. They collect the interest, pass the returns back to investors, and of course they charge some pretty nice fees for their trust. And listen, we're not talking about some tiny niche corner of the market here. We are talking about an estimated $2 trillion just in the US. To give you some perspective, the entire US corporate bond market is around $11 trillion. So this has become a huge, huge part of our financial system. The growth has just been, well, absolutely explosive. Since the 2008 financial crisis, this market has grown tenfold. So how on earth did this happen so fast? Well, it all comes back to what happened after 2008. New regulations came in that forced traditional banks to get a lot safer, and that meant they pulled way back from making riskier loans to businesses. And private credit funds, they were more than happy to step in and fill that gap. They could operate with way less regulation, they were willing to embrace that risk, and in a world of super low interest rates, they offered investors the promise of much, much higher returns. And for years, that model seemed to work like a charm. But recently, a string of high-profile bankruptcies sent shockwaves through the industry. And those were the alarm bells that are still ringing today. What's really wild here isn't just the bankruptcies themselves, it's the incredible speed of the collapse. I mean, in September, loans to a couple of companies were valued at pretty much full price. They go bankrupt, and almost overnight, those same loans are worth less than 20 cents on the dollar. Then you have Apollo losing every penny on a $170 million loan. And just a few months after that, BlackRock completely writes off a loan that it had valued at 100 cents on the dollar just 3 months earlier. This pattern started raising some really serious questions about how these funds were valuing their assets in the first place. And look, this isn't just about a few scary stories. The data shows a pretty worrying trend. Default rates for companies that borrow from private credit have been climbing steadily, and projections from big firms like Fitch and Morgan Stanley are suggesting the default rate is on track to blow past the highs we saw during the peak of the pandemic. Not great. So with defaults rising and all these valuations looking, well, pretty sketchy, what happened next was totally predictable. Investors saw the writing on the wall and they made a dash for the exits, which kicked off this massive wave of withdrawal requests. And this table really shows you how the funds reacted. See, because their loans are private, they can't just be sold quickly on the open market. So they couldn't just give everyone their money back. Many of them were forced to use these gating mechanisms, which is basically a fancy way of saying they trapped investor capital. Cliffwater, BlackRock, and Morgan Stanley all had to limit withdrawals, and one of Blue Owl's funds just halted them completely. And here's where a new, really big complication comes in. This market used to be a playground for big, sophisticated institutions, pension funds, endowments, who knew the risks of tying up money for years. But recently, these complex, illiquid products have been pushed out to everyday retail investors through things like 401ks and investment apps. And these are folks who may have had no idea their money could suddenly get locked up like this. So this all brings us to the big one, the question on everyone's mind. With all this turmoil, are we staring down the barrel of another 2008-style meltdown? let's actually weigh the arguments. Now, the good news is there are some really critical structural differences. Back in 2008, that subprime mortgage risk was deeply tangled up in the core banking system, and it was amplified all over the globe by these complex derivatives. Today, the risk in private credit is mostly held outside the major banks, and there isn't a huge derivative market to pour gasoline on the fire. The primary victims this time around would be the direct investors, not necessarily the global banks themselves. But, and this is a big but, that does not mean we're in the clear. There are very real reasons to be concerned. Turmoil here could choke off lending to small and medium-sized businesses, which could hurt the broader economy and jobs. And banks do have about $300 billion of exposure to these funds. Plus, critical institutions like pension funds and insurance companies are invested, which means this could hit the retirement savings of everyday people. On the other hand, there are some strong arguments for why everyone should just take a deep breath. That $300 billion in bank exposure, it's actually pretty small in the grand scheme of things. Other market indicators that measure fear are suggesting there's still a healthy appetite for risk out there. And some of the key metrics show that a lot of these loans are still performing just fine, with the defaults concentrated in the very smallest, riskiest companies. So, where does all of that leave us? Honestly, with a very uncertain future. Because the biggest risk in this entire market might not be what we know, but what we don't. And this really gets to the heart of the issue, opacity. See, unlike a stock or a bond, there's no public market that tells you what these loans are worth every day. Everything relies on the fund's own internal math. And that creates the exact risk we saw happen. The potential for everything to look perfectly fine one day, only to have a sudden, shocking write-off the next. Ultimately, we're left with a bunch of really unsettling questions. After a decade of easy money and this wild growth in the shadows, just how tangled is this web? We simply don't have a clear picture of how lax the lending standards really got, how much hidden debt is propping the system up, or how interconnected these giant funds are to each other and the wider economy. And in finance, it's what you can't see that so often hurts you the most.